Thank you very much, Senator. Senator Hutchison.
Thank you, Mr. Chairman and Mr. Chairman. I want to go back to the inflation threat, which I think in today and also previously you have said that it's not a worry, that half of your obligations are short-term. But I'm looking at the overall picture where some economists are beginning to look at the $10.6 trillion debt that we have, plus last week's stimulus or 2 weeks ago stimulus with interest is another trillion. And starting to look at the tipping point, 25% of our debt is held by foreign entities. What if they start saying, hey, this risk is too high and they want a higher interest rate? That on top of half of your obligations being somewhat long-term, are you concerned in looking at the overall picture about the possibility of inflation, and what could you do to keep that from happening through any kind of policy? Because obviously that would be a devastating turn for our country.
Well, inflation is primarily the responsibility of the Federal Reserve, and we consider that to be obviously half of our mandate, a critical element of our mandate. Our view is that over the next couple of years, inflation, if anything, is going to be lower than normal, given how much commodity prices have come down, given how much slack there is in the economy. When the economy begins to recover, it's important that we raise interest rates and do what's necessary to prevent an overheating that would lead to inflation down the road. And as I've mentioned, we are confident that we can do that, and every time we use our balance sheet to try to support the economy, we are thinking about how can we unwind that in a way that will be timely and allow us to take the actions we need to take. That's a somewhat separate issue from the debt issue. It seems to be, at least for now, that the dollar and U.S. debt are still very attractive around the world, and there's a lot of demand for holding our treasuries. That being said, I think it's self-evident to everybody that we can't go running trillion-dollar deficits indefinitely, and it's going to be very important as we emerge from the crisis and as we begin to go into a recovery stage that we get control of the fiscal situation and begin to bring down the deficit to a sustainable level. So I agree with you that we do need to address that issue. For the moment, foreign demand for U.S. securities is strong, but you're absolutely right. If we don't get control of it, eventually they're going to lose confidence.
Well, let me shift to the issue that many of us have talked about, and that is getting credit into the marketplace. Because the balance sheet of the banks has gone up so much now, holding their reserves in the Fed, and you're still paying interest to the banks, do you think that is having an impact on banks leaving their money in the Fed to get interest and having the reverse effect on what we all want, which is getting credit out into the marketplace?
No, Senator, I don't think it works that way. If you like, one way of thinking about what's happening is that the banks are nervous about lending given their concerns about their own capital positions and about risk aversion and credit issues in the marketplace. So in a way, what the Fed is doing is borrowing by paying interest on reserves to the banks, and that's where we get the money. And then we are standing in between the banks and the marketplace, using that money, recycling it into commercial paper, asset-backed securities, and other forms of credit. So in a way, we are becoming the counterparty between the markets and the banks. When the banks feel that they have opportunities, right now we're paying 1/4 of 1% interest on reserves. When the banks feel they have any kind of good opportunity to invest at better than 1/4 of 1%, they will. That will begin to create expansion in credit and money supply, and that will be the time, that will be the signal for the Fed to begin to pull back. But right now, it's clear that if the banks are more willing to hold reserves at 1/4 of 1% than they are to make loans, and so therefore we are stepping in to try to stimulate credit markets.
Well, let me just ask you then, what practical advice would you give us to try to help get that credit out into the marketplace? Because no matter what we say in Washington, go visit any person in a small business or medium-sized business that's trying to get credit for their business, and they say it is impossible.
And that's why, Senator, that's why the economy is under such pressure, absolutely. It's useful to think about credit as coming from two places, the banks and then the non-bank sources like asset-backed securities and commercial paper. On the banking side, our objectives, for example, working with the Treasury, are to try to stabilize the banking system, make sure they have enough capital to lend, make sure they have enough liquidity. And in addition, as part of our supervisory oversight, we want to make sure there's an appropriate balance between caution, which is critical. Banks need to be cautious in their loans. But on the other hand, we also want to make sure that they make loans to credit-worthy borrowers. They're not turning down good borrowers because their regulator told them they can't make a loan. We don't want that to happen. We know sometimes it does happen. So we're trying hard to tell our examiners, if the bank has a good loan to make and it's a good customer, let them make that loan, and we want that to happen. So that's the banking side. On the non-bank side, again, it's a difficult problem, but the Fed is doing its best to try to work through some of these markets together with the Treasury to try to get credit flowing again through asset-backed securities markets and other types of non-bank markets.
My time is up. Thank you, Mr. Chairman.
Thank you.